Ladies and gentlemen, thank you for standing by. Welcome to today's Seplat Petroleum half-year results conference call. At this time, all participants are in listen-only mode. There will be a presentation followed by a question-and-answer session, at which time, if you wish to ask a question, you will need to press star 1 on your telephone and wait for your name to be announced. I must advise you that this conference is being recorded today, Thursday, 27th of July, 2017. I would now like to turn the conference over to our speaker today, Mr. Austin Overwood, Chief Executive. Please go ahead.
Thank you very much. Welcome all to this broadcast this morning. It's our pleasure to be here on at least much more bullish mood than we have been in the past 15 to 17 months. As you're aware, after going through very deep 15 months of outage of the transfocados, the time we protect our core business under those very difficult conditions. As I promised in Q1, we upgraded water refinery alternative route such that if we have to bend backwards and use it in full, we will be able to transport between 25 and 30,000 barrels a day across that facility. We grew our gas business even year on year in spite of the constraints of delivering condensate. We actually grew the gas business year on year. We continued to deleverage the balance sheet, successfully extended the revolver that you know. Worked very, very hard to preserve a certain minimum liquidity level that kept the business going and healthy. We've kept the downward pressure on costs. Year on year, G&A came down 27%. Those were the critical steps we took to survive those very difficult times. Now we've had about of production and export through transfocados, and we are now cautiously optimistic, certainly much more optimistic than we've ever been in the past 17 months. And we are now transitioning to build a business, doing a work program that targets the high cash return production opportunities in our assets, both in the east and the west. We're working very hard to access the Scrambles pipeline. That will be a major de-risking facility once that is in place. We're targeting that should be fully in use in Q1. Finish all of this and commission it at the end of this year. Optimizing our capital structure, continuing to retire the legacy receivables. You see the details during the financial details, the financial presentation. We're continuing to reduce that. And more importantly, continuing to ensure that we're not building up any additional receivables as we move on. The annual gas and condensate project is still on course. Again, you hear more details about that. And we are hoping that with all of these activities, hoping no force majeure can handle means that if we're talking about 25 to 15% outage of the transportation facility, that we can take in our stride. If we're in that kind of limit, we think we'll be returning to full cash flow positive operations. And then finally, we'll reinstate at the earliest opportunity, we'll reinstate our dividend policy. So hoping we'll do all of this by the end of the year and going into Q1 2018, then we will begin to build the business to our satisfaction. We still think Nigeria remains the most prolific oil and gas opportunity set in south of the Sahara. And so we'll continue to leverage on our unique opportunities and position in Africa, in particular in Nigeria, and be able to access new production and development assets, particularly in the Niger Delta, as they become available. It's part of the reason we always emphasize, even during those difficult times, making sure that our balance sheet remains healthy, because we're going to put it to use as soon as there are opportunities for accessing new opportunities, new assets. We will, by the time we deliver the annual, we will easily become the largest supplier of natural gas to the domestic market. Right now, we supply about 30% of all the gas that is required for power in Nigeria. And by that point, we would have positioned Seplat as a leading indigenous E&P independent. So really, in summary, you will see that even through these very difficult times, we kept our eyes focused on our long-term ultimate goal of building this company to a large measure of resilience, no matter what happens in the future, and actually champion in the domestic space in Nigeria and West Africa. If you want to look at a historical working interest production, again, you look at half year average just over 26,000 BOE, 9,500 of that barrels liquid, and equivalent 16,900 barrels equivalent of that was gas in half year. We have now, having watched the production in the past month or so, we have been able to reinstate guidance, and we are guiding in H2. We are 25 to 29,000 barrels of oil and 18 to 21,000 barrels equivalent of gas, which put us in the bracket of 43,000 to 50,000 BOE working interest in the second half of the year. If we achieve that, then full year guidance, if you superimpose that on our first half actual production figures, the full guidance will be in the range of 35,000 to 38,000 barrels equivalent. Just a short summary of our activity updates. I said we'll prioritize diversification of our export routes to mitigate concentration risk. We've seen that as the hardest hit during this period, and we've tackled it. So we had a three-pronged approach. Working on the transfocados, so working with both shell and government to tackle all the risks and bring it back in service. We are also working, actually deploying capital, working on the barging facility to optimize it, which I just reported. So that is ready. The trials is working. The third leg of that whole plan is the Amukbed to Escravos pipeline, which delivers crude oil to the Chevron Escravos terminal. That work is in progress. It's 60,000 barrels per day pipeline, but in the first phase, when it is completed, it can deliver 50,000 barrels a day. In fact, just yesterday, we had a kickoff meeting with all parties, the original operators of the pipeline, Partnership, NNPC, JV, Seplat, the contractors, and NPDC in a kickoff meeting yesterday. So we're working hard to be sure that by the end of this year, we have that pipeline operating and able to deliver 50,000 barrels. The implication of that is that if we achieve this by the end of the year, it will really mean de-risking the export. Most export risk would have been taken care of, because we'll have between transfocados, Escravos pipeline, and barging, all three alternatives available to us. Even on the Focados terminal, we're working very actively with our injectors, indigenous companies also injecting into the transfocados. All six of us are working with government and share to see how best we can manage the risk of militancy in the region. So it's not just come back and then we're injecting crude. We're working as hard as we can to be sure that transfocados remains open. On our core assets, wells 438 and 41, we did some workover of the Rogo 7 production well. While we're out of production, we fully upgraded our liquid treatment facility, so we're able to take out the water from our production and actually export grade crude oil. It's what we put on the pipeline to focus. And as I said earlier, going forward, we'll be getting our highest cash return near-term production opportunities in our work program at this point. In our joint venture with Pila 2A3, we're planning just about starting to move the rig to drill a unitization well called a Nagba 1. On the other side of that aspect, ENI is actually has a production well on the other side. So if this well proves that it's a unitized field, then we're going to finalizing discussions with the ENI and the regulatory authorities to see what portion of that asset is on this asset. So it can be a near-term production opportunity if this well is successful as we think it should be. Unit 53, we're targeting short-term oil production gains, a couple of wells that will establish production in addition to the modest 3,000 barrels a day that we have continued to maintain. So by working it over every 6 months, hot oil treatment, and maintained a modest consistent production level in excess of 3,000 barrels a day. So when we re-enter this Haji Southwest, as we plan to do in Q4 early in the year, we'll be able to re-establish additional production. And that will be the beginning of taking production up, liquids production up, FU3. And this is different from the ANO project, which we deliver condensate along with natural gas. OMF55, we received our first payment, $22.6 million from the first lifting that happened in Q1. And as we progress, we continue to work with them under the auspices of the asset management team to make sure that production is maintained, and as production is monetized, we take our share of that production going forward. You get some of those details, more of those details when Roger presents the final details. And earlier, Warrior Exports route, that's up and running now, and it's available as a full alternative should we need it. Now, turning to our gas business, scaling it up, we have now commissioned our the 3 modules that we installed in Oban, bringing total production in Oban to 465, our total processing capacity in Oban to 465 million scf a day. And if you add the 60 million scf capacity available in Seplat, it means that we have now finally achieved what we had always forecast. Processing capacity of 525 over half a T of gas per day. And that's in Oban. And now we're working hard to FID and in 18 to 24 months after FID, deliver the ANO gas project that in the first phase we deliver 250 to 300 million scf of gas per day. Every time we watch both the market and availability of additional gas around OMF53 and the ANO entirety, once that facility is doubled to about 600 million scf a day, maybe 24 hours after we deliver the first phase, 24 months after we deliver the first phase, we would get in the range of our long-term 1 BCF per day processing capacity into the domestic market. So our gas business is, even through these difficult times, is on course to delivering the long-term capacity that we've always promised. So those are the key highlights from an operational point of view. Very minimal deployment of capex, very tight management of the resources that we have, cleaned up G&A, and using the opportunity of the downtime to upgrade some critical infrastructure and facilities that we need now that we're back on production. So I'll let Roger give the finance updates. Roger.
Okay. Thanks, Austin. If you turn to the financial summary, you see the results. We're not quite seeing the effect of Forcados opening. We've only had 1 month of it. So we've got a revenue of 132 versus 153 in the prior year. Oil volumes are down on prior year, but actually gas volumes are up. So there's an increase of gas volumes coming through from 54 million versus 47 last year. In the cost of sales, you can see a slight coming down of the cost of sales coming through, and gross profit at 54 versus 69 the prior year. Then we move it down into the G&A line, and the G&A, obviously, you're seeing as we reported, as Austin reported, seeing a reduction in G&A. We separated out financing fees and G&A, which is included as an IFRS requirement, show this separately. And then if you actually were comparing to the prior year with a number of one-off adjustments going through there, and FX losses and impairments, etc., and hedging adjustments. that's largely been eliminated this year. You can see the impairments and fair value adjustments of 9. That's really the premium on the oil hedging, which we struck at 47, and on average it's been higher than that. So the hedging hasn't quite kicked in at these levels. Tiny small FX movement, but there's nothing really material there. And then we have the net finance costs, which is on a debt package of 34. If you look at last year, that's like showing 16, but actually there was finance income going against that, and so separately I'd like to show you it's really 42 finance costs versus 34 this year. All translates into a loss before tax of 26, and then after some small educational taxes, that is a loss for the year of 27, or for the period. 27 versus 61 in the prior. So there's a reduction there in the loss, and actually in the gross profit, and we're actually got an operating profit as well in there. So we would expect to see Q3, Q4 the turnaround with the impact of Forcados. Going on to the balance sheet items, you can see there that the capex is obviously it's very controllable, 11, and we've got a slide on capex which we'll get onto in a second. Cash flow from operations of 106 versus 40 in the prior year, and we'd monetized some volumes in there, so we actually took the decision to strengthen our cash position, which is good risk management. Net debt has come down quite significantly, and from almost 100 million equivalent period last year to 432. Cash in the bank of 202 versus 180, and then receivables balances is continuing to reduce. Our would have been to reduce that further, but realistically, that should start to happen now with Forcados back up and MPDC monetizing volumes out of Forcados. If we turn to the next slide, we'll just do the cash reconciliation. Started with 160, you see the cash coming in from operations of 106. You can see the receipts coming in from WUMA of 55, and that should continue to monetize as the year goes on. PPE, fixed assets or capex is low. 12 loan repayments. That's really the big use of cash going forward is loan repayments and interest, and then obviously the year end or the period end cash balance of 202. Move on to slide, and this really gives us a good snapshot of where our capex really is, discretionary nature to it and the controlling of it, and heavy capex in 13, 14, and even into 15, and then you see the tail off there. And a lot of the capex in 16 and 17 has really been targeted on the gas business, which is the green box there, gas projects. For the remainder of the year, we're not guiding on absolute capex, but we're indicating that you've got committed capex of 20 million. That is related to the gas business, but then there's obviously some well activity as well in that. So we really are still in this very discretionary capex part of the cycle, but we are working towards looking at drilling out in the future, which is what Austin was talking about. If you then onto the capital structure and hedging, what we decided to do is give you in this slide a bit more detail on our debt packages. We obviously had $1 billion in debt at the start of 15. It's now showing 635 million, so it's quite a heavy servicing of that. We have reprofiled both facilities, the 7-year and the 3-year. The 7-year we did Q3 last year, and reported that we extended the corporate revolver for another year to the end of 18, and they then moved out $120 million of debt servicing. So the idea behind that really is to stabilize our business, show you results coming through, and you're not really seeing it in H1, you'll start to see it coming through in Q3. And then we haven't made a secret of this, we will then look to go out for a refinancing patch for the business back end of this year early into next year. And that's really looking at the debt maturity profile in 2018. You can see the impact of quite a heavy servicing or payback of the corporate and term loan. Not unusual this, we would expect to do a refinancing anyway. And therefore we are looking at a range of refinancing options and talking to a number of banks and providers of capital around that. Hedging, we're now going into H2 17 on our $50 hedges. So we expect some of those to be in the money at 1.7 million barrels around that, and that will reduce the premium paid on those. Next slide. So if we wrap up before Q&A, just to conclude, really we're splitting this business into three. It's protecting the core business, and then we've been doing a lot of that and strengthening the balance sheet, getting multiple export routes so that if there is a difficult period, then we have redundancy in that. The gas business, I think, we've demonstrated that we're growing that gas business, and we will continue to do that. And you start to see some good cash flows coming on the back of that. Liquidity buffer, we've been managing heavily, and cost control. But really, we'll be looking to transition into our build and growth mode on that. And we have, in our work program, we have over 70 opportunities. We will target those on the ones that are the more prolific and give better returns. H2 is really about getting this Escravos pipeline up and running. And then we will then really be looking at a refinancing of it and meeting this dividend, and then transforming into the future. We're a growth company. We want to be serious about being leading indigenous independent going forward and growing our scale here. So our business is underpinned by strong oil and gas fundamentals. I'm going to stop now, and I'm going to hand it back to Q&A. Thank you.
Ladies and gentlemen, we'll now begin the question and answer session. Please press star 1 on your telephone if you wish to ask a question. If you wish to cancel your request, please press the hash key. Once again, star 1 if you wish to ask a question. Our question comes from the line of Michael Ford. Please ask your question.
Good morning. Thanks for taking my question. I've just got a couple if I could, please. So firstly, just thinking about obviously putting guidance for the second half. I appreciate what is normal in the Niger Delta, but could you give me a little bit about what sort of the normal assumption that you use for sort of production uptime historically? Sort of 75 to 85% is what you sort of suggested is what you're assuming for production in the second half. I'm just wondering whether that was conservative or in line with historical planning assumptions. So that was my first question. And then just secondly, on CapEx, and again, I appreciate you're in a study sort of to export again. You have obviously great flexibility in CapEx, which is shown. But can you give some sense as to what and where we think CapEx could go to into 18 if you sanctioned the gas project? I'm just trying to get a sense as to how much CapEx could go, but equally on that project as a whole, what is the CapEx? What is F&D cost for that project? Thanks.
Thank you. Firstly, the assumption, as you rightly pointed out, we're assuming 5 to 85% production uptime. That's the key assumption going into that 40,000 to 50,000 BOE second half guidance. On CapEx, what we're saying is where we are now, the back end of the year and going into 2018, we will remain flexible on CapEx, and we will deploy CapEx into areas that will optimize returns as quickly as possible. For instance, I pointed out we could re-enter 2 wells in our Hedges out. Part of that work has been going on very, very low spend basis. So we can deploy some money into that, and quite quickly that could result in some production increase in OML 53 that will more than double where we are now. That's just an example of the fact that we can pick and choose CapEx deployment that suits our overall objective of building the balance sheet to very healthy state and returning to profitability. On the annual project, the funding of annual project is actually ring-fenced outside of the CapEx that we are discussing now in our business. That the funding, putting the funding in place, both equity and debt, is ongoing, and some of the prerequisites for FID. So once FID is taken, it means that project will run on its own steam over the 18 months that we think will deliver it. And when we deliver it, it will also run almost a ring-fenced, profitable project on its own, delivering both gas and condensate.
Understood. I mean, do you get into what the CapEx is on that project to get to when we think about the development of the, what is it, about 800 BCF of gas?
You remember that this is one half of what was a much bigger project that Shell has been handling. The annual project was a 600 million scope project, has now been split in two. We're doing one half of it. We're continuing to work on optimizing the cost of that project. All of that is ongoing. But across both fields, that is, if you take the total gross gas volume that is actually being developed, both by our own facility and the Shell 300 million scope facility, we're actually talking about 40 CF of gas that is being developed. So it's a major project in terms of the gas volume that is being developed.
Thank you.
Question comes from the line of Tami Adiroja. Please ask your question.
Good evening, everyone. Thanks for taking this call. I think my first question has somewhat already been answered, but I just wanted to understand and get some clarity. From your first half 2017 oil production, it seems like in June, Seplat produced 34,000 barrels per day for the month of June. So I'm just really wondering why the guidance begins at 26. Just seems very relative. My second question is there any update on the Azura gas contract? And my last question is it possible to get operating costs dollar per barrel for the Transforcados, Escravos, and Warri pipeline? And apart from the Transforcados pipeline, which other export route charges crude handling fees? Thank you.
Let me start with the crude handling. Every export route will charge a crude handling fee. On the Transforcados, there is a transportation cost for the pipeline itself, and there's a terminal charge paid to Shell for storing the crude and providing export facilities. If you put those two costs together, they're going up because, as you would expect, after Shell has spent so much money to put back the terminal into use, it came up with somewhat 40% or so increase in that tariff. So those tariffs are now creeping up to more like $4 per barrel, as against $3 per barrel, or $2.88 that it used to be. It's hard to look at $4 per barrel now, whichever pipeline you're following these days. That's like the norm. And you talked about Azura, from the indications they give to us, they are on course because they have notified us that in Q4 they will expect us to give them commissioning gas towards the end of Q4, November, December. So we target Q1 on schedule to deliver gas to the Azura project. That's how much we know from the information they give to us in terms of readiness. You're right, average 34,000 barrels a day in June, first month of full production, just back after 15 months. When you then factor in the risks that we're talking about, if we assume 75 to 85% uptime, then you see that we're being very reasonable and very realistic on the guidance of 26 to 29, and that we're giving on on liquids in H2. So we're not really being very pessimistic. Would like to see the full production at the end of the year turning out better than we guide. But realistically, the key element in that guidance is uptime. If uptime is higher than 85%, very unlikely. Then it should be higher than that. So that's how we derived those figures. The key element is uptime. I hope I took all your questions. Yeah.
The one that wasn't very clear is the operating costs for Warri, transfer cargoes, and escravos, apart from transportation costs, please.
Yeah, transfer cargoes has a transportation cost that is currently 80 cents. We know that's going to go up. Okay. And a terminal charge of almost $3, $2.98. So that's mean the total cost in transfer cargoes today is, heading around $4 per barrel.
I'll answer. Okay. So beyond that, then obviously the Warri cost, we've been quite clear around that, so around $11 a barrel. Yep. Cost. So that's made up of the transportational charges, minimal processing, because obviously we can dewater our crude, so we can actually export grade quality. So really, it's about the barging and a lot of that security costs around that. And then there's some discounting because we're putting new grade of crude into the market, which I think they call for Cater's Light. That should stabilise over time when we get that sort of regular market for that. So we may see some reduction in the barging costs, but that's roughly where it's going to be.
Thank you very much.
Our next question comes from the line of Kathy Daly. Please ask your question.
Hi, it's Paul here. Thanks for the call. Just a quick question. Are there any legal and possibly business reasons why you can't export all your crude through escravos and you would still need to use transfer cargoes from sort of first quarter next year if we can that escravos route is available?
The channel itself is debottlenecking their export pump capacity. On that whole project that will take at least 12 months, they can only take additional 50,000 barrels a day. In the first 12 months or so of tying into escravos, that's the first constraint. What they can take is 50,000 barrels. But even when you fully debottleneck, would like to keep a certain minimum volume on the transfer cargoes. That way we'll buy some capacity on transfer cargoes. That way that option is always available to us. So if something happens on escravos, then we can just kick up the volume on transfer cargoes, and vice versa. If something happens on transfer cargoes, we can take all the volumes we can into the escravos. So rather than just choose one, we like to keep both options open. Howbeit, by the time escravos is fully operational, will probably be our primary route, and then for cargoes we back up.
Thanks, sir.
Next question comes from the line of Gebenga Sholotin from Standard Bank. Please ask your question.
Good morning. I just want to find out, given that the transfer is up now, your production is improving, what's your view on our dividend payment this year? Do you expect to pay a dividend? That's my first question. And the second one has to do with the gas. The realizable price for gas is at 2.97 H1. Let's say it was 2.05. Can you give us a view as to what's going on with the gas price? Thank you.
To the gas price, it's just about price is a mixture of what goes on that domestic supply. That is the $2.50 price Brent, and some others that are on willing buyer, willing seller, that's slightly more than $3. When you take all of that weighted average, that's when you come up to the average price for the year. So during this period, a little more of the volume went into the $2.50 regime. That's just what accounts for that difference of 8 cents thereabout. Otherwise, overall, our contracts have not changed. What we said about dividends, that our ultimate aim is to restore dividend. That is subject to how healthy the balance sheet has become, our ability of the business, how much cash we want to deploy into the ground to create more value. So we'll balance all of that judgment and then guide for dividend. But the overall aim is to bring the business back to a point where we can be more consistent than we have been over the past 15 months on dividend payment.
And if you wish to ask a question, please press star and 1 on your telephone and wait for your name to be announced. If you wish to cancel the request, you may press the hash key. Our next question comes from the line of Ron Howard from Stifel. Please ask your question.
Hello, good morning. A suggestion on operational flexibility. So, is the advantage to keeping the Warri route open for next year or towards the end of this year, just to allow yourself flexibility to get that running up more quickly in the event that Forcados or Escravos in due course goes down? And second question, just a more general one on Nigeria and its contribution to OPEC. Sort of just talked about Nigeria re-entering the fold and providing cuts to production. I was just wondering if you have any thoughts on how those will fall if they are enacted. Thanks.
Thank you. What you described on the on our terms for the Warri funds is exactly what we're doing. We're still exporting minimal volume through that route, so that if something were to happen to Forcados, we can fall back on that route and optimize export through that route to the the volumes that we spoke about, 25 to 30,000 barrels a day. So that's ongoing. When it becomes fully functional and we have the full advantage of using both Escravos and Forcados, then we'll take a decision as to whether to continue to all the Warri refinery route or just keep in the background and pick it up if we need to, because then the risk of actually requiring the Warri export route to become much lower if we have both Escravos and Forcados running. But yes, right now we're keeping it open as an option. The Nigerian court, our understanding is the court is actually to bring Nigeria down to 1.8 million barrels of oil. That doesn't include condensate. So if you back out the condensate at 1.8 million barrels a day, that's pretty much what the country will do anyway at full production. Not much more than that. So from point of view of aggregate production by the country, there's really no significant cut in production. What we're seeing today is what they're capable of producing when there's no problem.
That's thanks a lot.
Our next question comes from the line of Craig Bendison from Kura Capital. Please ask your question.
Morning. My question actually just got asked, but perhaps a different question is, can you perhaps give us more color on what domestic producers are doing in terms of engaging on how better to protect the pipeline and how that would manifest itself from a cost point of view? And then a second question is, what is your feel? I know you gave the guidance of 85% uptime, but what is your feel kind of in terms of just the safety aspect right now? How confident are you that the environment can kind of stick?
It's all fast cross. What I can say is that all parties are honestly working to maintain the peace, starting from the government at the federal level. As you know, in September, October, the university was contentious. The Maritime University will start operating. They will be admitting students. That was one of the contentious issues. Engagement at the highest level with community leaders and the state governors from the region are ongoing, coordinated by both the Petroleum Minister and the Niger Delta Minister. The producers themselves are also much more actively engaging community service providers in every aspect to ensure that more grassroots jobs are actually created at those levels and more people are engaged. So all I can say is that all of us are actively involved in trying to maintain the peace. Now, to beat my chest and tell you how confident I am, that's difficult. But we're doing a lot more than what was being done to ensure safety in the Niger Delta. Now, even on top of all that, as I said, we're trying to build sufficient business redundancy. So you have two export routes that are completely different that are available to you, an emergency badging outlet that is also available to you. Those are things we're capable of doing to de-risk our business rather than just pray that there is no crisis in the Niger Delta. So all of us are working as a team from top to bottom to ensure that those pipelines remain open.
Yeah. And then Austin, on the costs of, you mentioned that domestic producers are also kind of working directly to manage the pipeline better. Is there direct cost estimates you can give me there?
There is always a cost, but for you to have a feel of it, Roger just told you that our margin costs were averaging $11 per barrel. We're hoping to, if we go back and we'll badge larger volumes, at best to bring that down to $9 per barrel, versus an increased TFP cost of $4. So you can see clearly the difference. Even if we were to spend an extra 50 cents to transfer cargoes operational, is much lower cost than badging. Plus every other thing that goes with it. So really, in terms of incremental cost, to have all of these activities to keep the pipeline safe, it's not any mind-boggling cost. It's about the success really of all the activities put together to make sure that those pipelines are open. When they are open, it's still a lot less cost. But by the way, because the minister is asking all of us to come up with processes for reducing overall operating costs below $15 per barrel. That's the target. When you look at even the $4 cost on transfer cargoes, that is the largest single cost on OPEX for anybody at $4 per barrel. So if we really were to be operating at real optimal OPEX of less than $15 per barrel, even the transfer cargoes cost ought to be in the region of $2, $2.50, and not $4. And so when you start getting to $9, $11 on badging, you see that those are costs that cannot match oil prices at $40. So there's a lot of work that will have to be done if we have to bring the overall OPEX down, because that's the name of the game going forward.
Yeah. Cool. Thank you.
Further question at this time, please continue.
All right, thank you all very much, and let's all pray, as we say in Nigeria, for better times as we move forward. Thank you very much.